What if the biggest threat to silver is not demand, not supply, but the exchange that controls the rules of the game? What if the rally everyone was waiting for just got quietly strangled overnight? And what if the move was not protection, but a calculated rug pull designed to stop $85 silver before it ever arrived? The silver market did not fail. It was stopped. And the timing tells you everything you need to know. Just as silver was gaining momentum, just as positioning was becoming dangerous for the wrong side of the trade, the CME stepped in and slammed margin requirements. To most people, that sounds boring, technical, harmless. But in reality, margin hikes are one of the most powerful weapons in the entire financial system. They do not change the fundamentals, they do not change the supply of silver or the demand for it. What they change is who is allowed to stay in the trade and who is forced out immediately. Here is how this really works. When margins are raised, every trader holding a futures position is suddenly required to post more cash. Not tomorrow, not next week, immediately. If you cannot come up with that cash on demand, your position is liquidated, not because you were wrong, but because you were undercapitalized. That liquidation creates instant selling pressure, even in a market that is fundamentally strong. And when enough positions are forced out at once, price collapses fast. Now ask yourself a simple question: why now? Silver was not crashing. Volatility was not exploding to the upside. There was no sudden emergency. In fact, silver was behaving exactly how a breakout market behaves: higher lows, strong bids, tight physical supply, rising open interest. And that is the key. Rising open interest during a price move is dangerous for anyone short. It means new money is coming in. It means conviction is growing. It means the trade is working. $85 silver was not a meme. It was a trajectory. Industrial demand is not slowing. Solar, electronics, defense, electrification, all of it requires silver. At the same time, above-ground inventories are thin, mining supply is stagnant, and physical premiums are stubbornly high. That is not a bearish setup. That is the kind of setup that breaks paper markets. And that is exactly why margin hikes always appear at the same moment in history. Not at tops, not after collapses. They appear right when price threatens to escape control. This is not new. It happened in 1980. It happened in 2011. And it is happening again now. Every time silver starts to behave like money instead of a commodity, the rules change. Supporters of the move will say this is about risk management, about protecting the system. But if risk was the concern, margins would be lowered after forced liquidations reduce leverage. That never happens. Margins go up on the way up. They stay high on the way down. And the message is clear. Volatility to the upside is unacceptable. Volatility to the downside is perfectly fine. This is why calling this a rug pull is not exaggeration. It is an admission that the paper silver market cannot survive true price discovery, an admission that too many players were positioned on the wrong side, and an admission that $85 silver was close enough to be feared, because once silver crosses certain price levels, control is lost very quickly. The leverage flips, the shorts panic, physical buyers stop selling, and the paper promises start getting questioned. At that point, margin hikes are no longer enough. So the exchange acts early while it still can. Look at who this really hurts. Not the banks, not the large commercial players with deep pockets and preferential access to liquidity. It hurts smaller funds, retail traders, anyone trading with conviction but without unlimited capital. These are the participants who add fuel to a breakout. These are the hands that refuse to sell at $25, $30, $40. And these are the hands that get shaken out first when the rules suddenly change. This is why silver is different from gold. Gold is allowed to rise slowly, predictably. Silver is not. Silver is volatile by nature, and that volatility is a threat to the credibility of paper markets, because silver is small, thin, highly industrial. And when price moves, it moves violently. There is no room for gentle adjustment. It gaps, it squeezes, it exposes leverage instantly. The CME understands this. They understand that a disorderly silver rally would not just impact silver, it would ripple through currencies, bond yields, mining equities, and industrial input costs. It would raise uncomfortable questions about inflation, scarcity, and trust in financial plumbing. So the move is framed as neutral, mechanical, necessary. But the outcome is always the same. Price is capped, momentum is broken, confidence is shaken. And here is the part most people miss. Margin hikes do not remove risk, they transfer it, they concentrate positions into fewer, stronger hands, and those hands are usually already short. When weak longs are forced out, shorts get relief. They cover into forced selling. They roll positions. They buy time. That is not market stability. That is market intervention. Notice how quickly sentiment flipped. One day silver is breaking out. The next day headlines talk about collapse, failure, rejection. Nothing changed physically. Mines did not reopen overnight. Solar demand did not disappear. Vaults did not magically refill. Only the rules changed. And when rules can change overnight, price becomes a policy tool, not a discovery mechanism. This is why $85 silver matters so much. It is not the number itself, it is what happens beyond it. Above certain levels, futures markets lose their ability to dictate reality. Physical delivery starts to matter. Backwardation becomes persistent. Premiums decouple. At that stage, RICE, NG margins does not stop the move. It exposes the system. So the exchange acts before that point. Always before. They do not wait for confirmation. They preempt it. And they rely on one thing above all else. Fatigue. They rely on traders getting tired. On investors losing patience. On people saying maybe this time is different, maybe silver just cannot break free. But history shows something else. Every suppression creates pressure. Every forced liquidation transfers metal to stronger hands. Every delay makes the eventual move more violent. Silver does not forget. It stores energy. And when it finally moves without restraint, it does not ask permission. The real question now is not whether the rug pull happened. That is obvious. The question is whether it worked. And the answer depends on what happens next. If the goal was to kill the silver story permanently, this move will fail. If the goal was to buy time, it may succeed briefly. Because margin hikes can slow a market, but they cannot change reality. And reality is becoming harder to hide. Watch what does not fall. Physical premiums, long-term industrial contracts, delivery wait times, mining costs. None of those respond to margin requirements. They respond to scarcity, and scarcity is still here. In fact, it is growing. The energy transition is accelerating, not slowing. Electrification is expanding. Military demand is rising quietly in the background, and silver sits at the center of all of it. This is why the disconnect between paper and physical keeps widening. Paper silver can be forced down with rules and leverage. Physical silver requires metal. And when enough participants stop trusting paper claims, the entire structure becomes unstable. That is when exchanges lose power. Not overnight, gradually. Then suddenly, think about what forced liquidations really do. They push metal out of speculative hands and into patient hands. Investors who do not trade on margin, who do not get margin calls at 3 a.m, who buy with cash and store metal outside the system. Every cycle strengthens that base. Every intervention accelerates that transfer. This is why silver has always been the most dangerous metal to suppress. It is too important industrially to be ignored, and too small financially to be controlled indefinitely. Gold can absorb pressure. Silver cannot. When demand overwhelms supply, price has nowhere to go but violently higher. $85 was never the end. It was the beginning of a repricing, a signal that silver was moving from a manipulated commodity to a strategic material. That is what truly scares the system. Because once markets start pricing silver as critical infrastructure, the old models break. The CME knows this. The banks know this. That is why the response was immediate and aggressive, not because silver was unstable, but because it was becoming stable in the wrong direction. Up. So what happens now? In the short term, volatility, shakeouts, headlines declare. Airing the move is over. That is always the playbook. But underneath, the structure keeps tightening. Inventories draw down. Demand contracts get locked in. Mining projects get delayed by costs and regulation. And the next move builds quietly. The real signal will not come from price alone. It will come from delivery stress, from rising lease rates, from backwardation that does not resolve, from premiums that refuse to fall even when futures do. Those are the cracks that margins cannot patch. The rug pull was real. But rugs only work when people are standing on them. More and more participants are stepping off. This is not financial advice. It is market anatomy. And silver has been here before. Every time it is suppressed, it comes back stronger. The only difference now is scale. The world needs more silver than ever. And there is less of it available than the market admits. The exchange can delay price. It cannot repeal supply and demand. And when that reality finally asserts itself, $85 will not look extreme. It will look inevitable.